You've probably noticed that Meta's stock hasn't exactly been crushing it lately. It's been lagging behind the S&P 500, and once again, investors are getting nervous. The reason this time? Not the metaverse, but AI spending. After Meta's latest earnings, the stock fell nearly 17%, and the reason was clear. Wall Street's worried about rising capital expenditures, all that money Meta's pouring into AI data centers, servers, and model training. Analysts sounded cautiously optimistic, but their questions all circled around the same theme. Where's the return on this spending? If that sounds familiar, it's because we've seen this movie before. Back in 2022, when Mark Zuckerberg went all in on the metaverse. Investors panicked then too. The company burned through billions. Reality Labs kept losing money to date, over $73 billion, and Meta's stock crashed more than 65%. But here's the thing, the market eventually realized Meta's core business, advertising, was still booming. Profits came roaring back, and the stock staged an incredible recovery. And now, we might be looking at something similar, except this time there's one big difference. Unlike the metaverse, AI spending actually strengthens Meta's core business. Think about it, these massive AI investments aren't going into some speculative virtual world. They're going into infrastructure, data centers, algorithms, tools that make Facebook, Instagram, and Threads better. Smarter means more personalized content, more relevant ads, and more engagement. And when ads perform better, advertisers spend more. It's a direct feedback loop that boosts Meta's top line. Even a small improvement in efficiency can have a huge financial impact. For example, if AI helps Meta lift its EBIT margin by just 2 percentage points, that's roughly an extra $4 billion in profit in 2025 alone. So yes, short-term spending is high, but the payoff could be enormous. The market's treating it like another metaverse situation, but this time, the math and the logic are completely different. Let's dig into that math for a second. Meta's EBIT margin currently sits around 41%, one of the highest in the industry. Historically, it's been able to turn about 80% of EBIT into free cash flow, which is outstanding. Because of the current AI build-out, that number has dropped to around 50%, but that's temporary. As the infrastructure stabilizes, those conversion rates should bounce right back. If we take Meta's 2025 revenue guidance, roughly $198 billion, and assume conservative figures like a 9% WACC and a 3.5% perpetual growth rate, the numbers show something interesting. Meta only needs to grow its revenue by 10% a year for the next 7 years to justify today's valuation. Just 10%. And here's the kicker. The global digital advertising market is expected to grow around 15 to 16% per year, all the way through 2033. If Meta simply grows in line with the market, no miracle needed, its fair value could hit $2 trillion, meaning the stock might be undervalued by around 33% right now. Of course, there are risks. Ad spending depends heavily on the economy, and tighter budgets can slow growth. Regulators are still watching Meta closely, especially around data privacy and competition, and the massive AI investment push will weigh on cash flow for another year or two. But even with all that, the key takeaway is simple. This AI spending is not a waste, it's an upgrade. Meta's short-term cash squeeze is the price of long-term dominance, not just in social media, but in digital advertising powered by AI. The same way Apple built an ecosystem around hardware, Meta is building one around intelligence. Smarter feeds, smarter ads, smarter engagement. So while some investors see this as another metaverse moment, it's actually the opposite. The metaverse was an experiment. AI is evolution. And for long-term investors, that evolution could be the setup for another Meta comeback story, just like the one we saw after 2022. That's why right now, I'd call Meta a buy.